We were last together in Tokyo, about 15 years ago? And how have things changed? Has the perspective of investors about the Japanese markets changed that much?
Well, certainly it would have been around then, and things have changed. And I would say changed for the better. Not only are we in a reflationary rebound, but I think we've seen some real signals of structural reform amongst companies, for example. We're starting to see corporate governance changes. We're seeing different allocation of corporate balance sheets, investment. And I think now we're just waiting for the last piece of the puzzle, which is the household. We're going to, at some point, probably see better real wages this year. And so it's probably, I don't know exactly when, but it's probably a matter of time before we see real wages come positive in Japan.
Have you seen that difference coming especially from the Shunto spring wage negotiations that could potentially filter through in that optimism with the markets?
Well, I think the Shunto spring wage negotiations are certainly a good signal. They do tend to lead, and seeing historic wage gains is certainly not bad. But I would also add that we have structural labor shortages in Japan, and those actually affect non-unionized labor more. So, if anything, non-unionized labor is in a better negotiating position.
I've heard stories about part-time workers actually making more than fully salaried people in Japan now.
Well, if we are faced with structural challenges to raise wages, as with a lot of full-time workers, then the natural, logical step is to look at raising part-time wages to retain a lot of those workers. So that fits in with the structural labor shortage story.
Naomi, I wanted to check in terms of your assessment of where the Fed goes from here, right? There seems to be a little bit of repricing going on. We've been sort of higher for longer for so long. Did the data towards the end of last week convince you that things might change, that would be a little bit less cautious going forward?
Well, our outlook was always that we would see a gradual disinflation. So I'm still not discounting, for example, another rate cut before the year end. It's just that it's a bit of a process, and it's not very smooth. So I think we've seen data sometimes that does end up being stronger than we expect. And I think probably the bias is a little bit on the inflationary side. That said, I don't think cycles are dead, and we are starting to see some softer data come out. Thankfully, we haven't seen any type of really strong pullback or drop in the U.S. economy. So if we can kind of see a gradual disinflation, then I think we probably have a pretty good outcome for global markets.
At this point, do you want any exposure sort of directly, indirectly through equities or otherwise to China, given the shakiness of the recovery story there?
Well, with China, I think perhaps maybe the undersung story there is the bond market. With the economy soft and probably struggling to really rebound, we have a market there that probably is going to expand, yet have quite a lot of demand to issue into. China bonds actually provide pretty good diversification within a global portfolio. And also, if we look at global reserves, they're underallocated to Chinese renminbi, and probably because the Chinese bond market has more liquidity to build. So I would be really constructive on Chinese bonds right now.
We saw the sort of tensions that were building in the Shangri-La dialogue in Singapore over the weekend, right, with obviously two very different worldviews being set up by the US and China. How closely are you looking at these geopolitical tensions, particularly as we go into elections in the US in November?
Well, I don't think we can discount the geopolitical risks at this point, even though the markets have really not risen to kind of increase volatility or anything like that. I think that's one of many geopolitical risks, and then there is a real risk that trade tensions could rise further. We do have elections coming up in the U.S., and usually you see very strong views around election times. That said, I think there's still a lot of appetite, at least, to find value in risk assets and value in many assets, but especially in risk assets. So it doesn't seem like the markets are too phased yet. I do think that we do need to keep a well-diversified portfolio, though, because it's hard, as you mentioned. There are some eventualities that we probably can't predict.
How much of that includes dollar cash, just stuffing it under the mattress, given the eventualities that you're saying we can't dismiss?
Well, dollar cash is really well favored right now, even more than the long end of the U.S. yield curve, given the inversion there. And it provides better diversification than it has in the past. And so now, but the thing is, I think everybody holds so much dollar cash. So really, we also have to start thinking about how do we diversify away from dollar cash. So in addition to what I mentioned before, the Chinese bonds, I think there might be some reason to also hold a bit of renminbi as well, even though that's not yet as liquid and deep a market as probably it will be one day.
And what about gold bars? Or, to be fair, commodity stocks, which I know that you have said before that you favor?
Well, commodity stocks are probably also good for two reasons. Number one, they do provide some diversification within equities. And number two, I think right now, looking at AI is a really crowded trade, even though eventually we might see some productivity enhanced from the technologies around today. But what we are pretty certain of is that you need a whole lot of energy to run those technologies, and perhaps those commodity stocks aren't as crowded a trade as the actual AI stocks.
When it comes to commodities, that on top of the fact that you mentioned yuan for a little bit of more exposure and diversification, a lot hinges on China, right? What happens to China and the property sector and everything that's going on. Have things changed in the last few months, given the push that we're seeing from Beijing and local governments to support the property sector?
So I guess on one hand, I do think that China has a lot of material with which to support the property sector. But on the other hand, we've seen that they've been very reluctant to give handouts. They don't want to give rise to an idea that this is moral hazard in the making. They probably want to be a bit judicious with a lot of the capital that they do have. So this is perhaps why I think the bond market in China maybe deserves greater attention right now than stocks. Even if stocks do rebound, there's a lot of building to be done in the bond market. And that bond market might well be some of the support given to the property, the stocks, the household balance sheets. And then there's probably a good, pretty receptive market to issue into.